Welcome everyone. We couldn't do Friday webinar last week, and Bhavin was available today, and we thought of kind of catching him for getting his wisdom because markets globally have been in a state of flux. Though over last three trading sessions, markets have cheered up, which we see because of the expected earnings and maybe a rate cut in the US. But we want to understand more from Bhavin on where are we headed in 2026, what to expect, and how to position our portfolios. Bhavin brings with him illustrious experience of more than 3 decades, has worked in the US and has his knack in IT sector. And IT sector is also going through a lot of disruption and maybe a period of transformation. And maybe that this is the period which should be seen as an opportunity as well. And valuation wise also it is attractive. We have seen financial services similarly went through similar, I would say, fall, and it was like a phase where financial services sector was not performing in last 3 years, and now this rally which we have seen maybe is the one which is being led by financial services. Why have we selected Bhavin? Because rarely we see fund manager who is able to keep his greed and fear aside and is able to do proper rules based investing and mathematics based investing. And Bhavin doesn't only say that, doesn't only kind of I would say mention that in his decks, but has also demonstrated. We have been working with him for last almost 3 years, and every time when we have evaluated Sameeksha as a strategy on numbers, we have seen it has kind of always shown very superior information ratio, which is primarily because it not only delivers alpha but also manages the downside, the drawdowns very well, and hence on risk adjusted number returns does really come out well. And that is the reason we thought of doing this webinar with you. Bhavin, welcome to this webinar. So you have already heard my beginning and context. Maybe your first views on markets ahead. We have seen markets sharing. Is this confusing you as well, or you are as per your portfolio is aligned to kind of participate in this market, and whatever we have seen in last 3-4 trading sessions is something which you are expecting?
Yeah, so I think if we go back to the start of this recent uptick in the market, what were the conditions? Number one, we had looking forward to a year in which the government spending on infrastructure is likely to get a meaningful boost after a very subdued election year. From month of April onwards, people urban, middle class will start to see more money in their bank account in the payroll because of the tax cut that government announced in the budget. India's inflation was already coming off, and I think RBI seems to be looking at reducing the interest rates, and we have already seen some of that. So that I think is also playing into this. Now, even without the whole tariff saga, with the Trump in power, crude was headed down because of the policy that Trump pursues, and a crude falling is positive for India. So I think when we look at number of factors, and plus after some disappointment in earnings, with the expectations being reset, there is a less risk of earnings disappointment ahead of us. So I think all these things were in place, and that's why. And then you bring in the whole Trump equation and the tariff announcement. And I think it was interesting how Indian market reacted. And I think it was, we were not surprised that Indian market reaction was fairly subdued. Did not see a big correction because, India having a small exposure to US, relatively speaking, and also in a better relative position versus the countries with which India would compete, and plus some new opportunities that may emerge out of all of this. I think, the Indian markets didn't react too negatively. If anything, we have started to see this rally as earnings season has started. And, I think earnings are not, causing any more negative surprises. So the other important factor I forgot to mention is the valuations. So we look at valuations in a very different way. We have our own proprietary ratio. I call it Sameeksha ratio. It's a combination of return on equity, price to book, and interest rates. Those three things that always matter the most to valuation. And on that basis, the large caps actually look very attractive. I think, and they still look. attractive overall. Mid and small cap still a bit of a froth there, but then I think there were a number of interesting opportunities that opened up because of the correction before us. So all these factors together, I think we're setting the stage for India. I mean, global uncertainties are still meaningful. How the whole tariff plays out. But I'm willing to stick my neck out and say that in the end, I think the realities of the market and the realities will prevail. And I think, as was done with the 90-day pause, a far less harmful tariff picture might emerge because there is going to be a lot of pressure building up on the US president from his own people, given the impact and devastation it can cause to the US economy. So that's, I think, how I see the market. I think we are in a reasonably good state when we look ahead.
Sure, Bhavin. So I agree with you that optimism emerges out of peak of pessimism, and I think 7 days ago we were at a peak of pessimism, or maybe 10 days ago, 2 weeks ago. But right now, again, market mood is reminding buyers and investors to have a long-term positive perspective and focus on fundamentals like valuations and growth in earnings, plus the possible increase in liquidity towards equities as other asset classes have also grown a lot. So what is your view on gold? Because a lot of investors over time have been asking these questions that, many fund managers, including you, may have missed putting some money in gold Bs. Like you were holding cash, you could have put money in gold. As a fund manager, and we are talking about not only equity, we are talking about making money. Gold also gave a very brilliant opportunity to make money. But I think all fund managers missed that.
Yeah, I think we're perhaps programmed not to think about gold as an investment or a class, more of something where, we expect investors to, put aside some part of their savings in a gold, So in other words, we expect investors to handle that outside of our equity portfolio. We are, meant to be more of equity focused. But yeah, I accept that, we could have taken advantage of this whole situation with respect to gold, being the money shifting to gold. But I think gold is it's also a commodity, and I think what can such prices do is encourage a lot more production. And once you start getting into that kind of equations, that's not something we generally tend to invest. We rather have investors take their own gold call. I think in general, it's good to have a small part of the portfolio invested in gold.
Sure, Bhavin. With recessionary, fears in the US and which might come live, given the tariffs, and US has been trying to not go in recession earlier, kind of in 2008 after subprime crisis, after doing maybe very meaningful rate cuts for 10 years, keeping rates low. US tried to avoid itself from recession and in fact went back into a, I would say, flourishing and growing economy, and which ultimately led to massive inflation. Now, it's back to the, I would say, older fear of again recession. This time they cannot kind of print money, cut rates, and that is where ultimately the kind of another view is that it is like they are welcoming recession. They are wanting growth to come down so that there is a room to cut rates, and the yield going down reduces their, I would say, interest servicing cost, and maybe ultimately will have its own implications. I'm sure you are aware of all these things. How do you comprehend the present complex environment coming out of US being the largest economy, largest stock market, and what risk or what potential does it actually position or present in front of us for financial year 2026?
So first of all, I would not give credit to the current administration for having such a multidimensional or multi-layered thinking. I think they don't seem to think beyond first order. Them trying to engineer a recession is too far-fetched in my view. I think the intellectual depth in the current administration is very low, and I think they seem to take decisions by their whim, and then if it if it looks like it's causing devastation, they backtrack, and I think that's what I expect to see more of in coming weeks. I think, and let's see how it plays out with China. Now, as far as recession risk, I agree there is a high recession risk. In fact, it is quite imminent. In other words, recession, US might see recession even this quarter. It is very possible because, the longer this prolongs, there's going to be more disruption in the supply chain. There's going to be more confusion among the consumers. And I think we are already starting to probably see the impact of all of this. So there is a possibility of a recession for sure. But given where we started off, in terms of the economy was in a very good shape, and I think the latest numbers or more recent numbers actually do suggest that chances are it could be a shallow recession overall. But all of this assumes that because of the pressures from the market, pressures from the constituents, the voters, I think the U.S. administration would have to back off from some of the tactics that they have been following.
Sure, Bhavin. So let's go with your assumption, and because we also believe in the same that this is like going to ultimately be reversed, and very milder version will ultimately come out. And if that happens, how will it impact tech as a sector? Because IT sector is like today absolutely at a bottom. It has, if you see the median P of stocks like TCS, Infosys, and the current trailing P, I think it is more than 15% lower than the median P. And there are not only, I would say, tariff-related reasons, because in fact tariffs have not been placed on services. It was always on goods. But there are many other, I would say, factors which are impacting IT services industry in Indian context, because of maybe the exports eventually coming down if US goes in recession, or because of competition coming from AI, and because you are a tech specialist, like your career began with being a tech analyst, and you have seen that in depth. How do you see the current fall in some of the tech giants in Indian context as a trade, as a good advantage to maybe enter at a good valuation, or you think that it is not at all a good time of a long-term, I would say, beer run in the space of IT services companies in Indian context?
Yeah, so let's talk about tech for a minute. I mean, I think first of all, my career in financial industry started by looking at tech sector, but I also worked in the tech sector designing microprocessors. So I think coming to the current situation, I mean, I think I come to the similar conclusion on valuation using different parameters, but the same conclusion as you. And I think last time I saw this kind of parameters or this kind of valuations was at the start of COVID. And obviously, it was a great opportunity to buy the Indian IT services names. So the parallels can be one can start drawing those parallels. However, here are the differences. We were heading, getting into COVID, we were looking at a surge in demand for IT services because everyone had to put in place their tech strategy and implement in a hurry to respond to the new challenges of COVID. Heading into the current situation is already a slowdown in demand for IT services. Some of it led by the whole Gen AI, evolution, and causing companies to divert their spending towards that, or delaying some of the existing projects. And I think we have seen that in the numbers of the large IT service companies that have already reported, as well as their guidance. So there is a big uncertainty with the growth, even before you bring in the issue of potential US recession and uncertainty because of the tariff war. So now you bring that additional element into the equation, and the picture becomes extremely, clouded. We would be very careful to extrapolate here, for anything from the past. You look at the situation before COVID, IT sector was already seeing a slowdown in growth rates. In other words, the trend growth for Indian IT services was already headed down to mid, at the most slightly higher than mid single digits. Then came COVID and we saw a bump. and that bump kind of went away. And last 2 years, if you look at numbers of most of the companies, we have already seen a slowdown for 2 years now, 2 years to 3 years, depending on the company. So the growth rates, so if you draw a line of the trend growth rate, it was sort of going down, then came the COVID bump, and now you go back and sort of draw that trend line, that's where we are headed. It's a highly mature market, a lot of penetration, and I think as a result, lower growth rates are inevitable. Then you bring in Gen AI. Now, you look at Gen AI. So historically, all the technology transitions or disruptions were positive for Indian IT services because it resulted in more work for Indian IT services. Because new code had to be written to take advantage of new technologies. What Gen AI is doing is basically reducing the work for Indian IT services because it is causing a big one-time productivity boost. And not only one time, there will be probably more productivity boosts coming along as Gen AI continues to evolve. So you look at the whole picture, and it's almost like a perfect storm for Indian IT services. You have technological disruption, which is negative. You have the whole US economy and global market situation currently in a flux, and then you have a saturation in the end markets and that which is causing the trend growth to anyway slow. So when you combine all of that, what is the growth rate for Indian IT services going forward? I mean, I don't know. I think, and I wouldn't want to, despite the valuations being very attractive, I wouldn't want to jump in right now.
Sure. So I'm assuming that your allocations to tech in your PMS and AIFs are minimal.
Yeah.
Perfect. Now, moving on to your, US fund, because you also have a, US global fund, which is like 60-70% in US and, other economies also. And we know, there are like all these giants, like, big 5 companies in the US, as well as maybe in China, which are also beaten down, which are like ruling the tech worldwide. I'm talking about Google, Apple, and all companies. Is it do you see for an HNI, ultra HNI investor to allocate money to your global fund at present making sense?
So I think there is 2 or 3 parts to this question. There are 2 or 3 part answer to this question. One is, on a longer term basis, what should be the portfolio strategy for any investor, including an Indian investor? And I am talking about Indian resident. So even if somebody is an Indian resident, depending on whether they see any future need, for education of kids or maybe potential travel or health related, they want to have certain amount of money invested in dollars or not. That is the one important consideration. A second consideration is purely from an investment theory consideration, which says that as you broaden your investment frontier, your returns tend to go up and the risks tend to go down. To give you an example, let's say somebody said, I'm only going to invest in companies based in Maharashtra. Another investor says, I'm going to invest in companies across India. Now, it is very easy to understand that the investor who looks at companies across India are more likely, provided both have similar skills, is likely to see that the investor looking at India as his investment compass is likely to see superior returns and lower risk, lower volatility. So now when you bring in the whole world into the equation, then obviously your investment frontier is widened even much further. I mean, India at the end of the day is a small kind of fish in a big pond, so to speak. So I think from a portfolio theory perspective, it is a good idea to have some money outside India. I think, and we strongly recommend, with US as being the main anchor market, because one, US has historically been a great, economy with a very strong, free market economy, very strong focus on equities. It has shown the US market has generated many dominant players in many industries. Second, now over last decade and last couple of decades in particular, a lot of US companies have established global dominance. So not only are these companies giving you exposure to the US economy, but they're giving you exposure to global economy. And third, most of the important non-US companies having exposure to the world economy are also listed in US. So when you look at our investing, we call it, it is the global investing because we are not only investing in US market, but we also invest in Europe and Asia. But yes, clearly the dominant part of the whole portfolio is US listed companies. And I think with a view that the current situation, will not sustain for too long, we would suggest having some allocation to US, though I think India, is also attractive, as I said, and I think so one has to sort of take that call. But yeah, some investment, in non-Indian portfolio is definitely a good idea.
Sure. So strategically and theoretically speaking, with the horizon, with the context of, market frontier theory that you mentioned, I agree with you. But thinking from the point of view of, say, current timing, because investors are like more of the, I would say, inquisitiveness is to understand that today as an investor, I already have exposure to China, already have exposure to US, already have exposure to India. I already, I am diversified. But if I have my incremental money coming in, because we are not creating a fresh portfolio for a client, we are here asking this question from the point of view of allocating new money. Should that money be allocated to US? Because it could be possibility that US may actually underperform in next 2-3 years. Like China, China has underperformed in the last 3-4 years. Japan underperformed for 10 years. So, from that point of view, maybe, it's like we are seeing the beginning of a bear run in the US. Do you agree or subscribe to this argument?
Well, if the current quality of decision making by US administration continues, then I have very little to disagree with that theory, that argument that US could underperform for multiple years. But I believe that at some point, this will change course because of the pressure from the market, from the people who have given funds to the party and the presidential election, and also general unrest in the country. So I think those factors will play out, and I think that should be the final situation. But yes, I think currently it does look, the way things have been going in the last few weeks, it poises for a pretty disastrous situation. Yeah, Kamal.
Sorry, I was on mute. I was saying, another positive aspect which has been making money for Indian investors who have exposed themselves to US was the relative rise of dollar. What is your perspective and I would say expectation on dollar, going ahead?
Well, I'm not an expert on currencies. I always work with a very simple premise that the currency rate between any two countries is in the long run going to be based on the difference in inflation between those two countries. In the long run, that does play out. In the short run, currency can be dependent on many factors, inflows and outflows and whatnot. I think US dollar may be a little bit of exception in some cases because of its status as a reserve currency. And ironically, its status as a reserve currency has strengthened in last 2 decades. If you go back 20 years ago, compare, the percentage market share for US dollar of global trade versus today, it has gone up significantly. Euro is, it has come at the expense of euro. I think despite all the noises people make about Chinese currency and trades in Chinese currency, it is still very, very small, albeit growing at a very fast pace. I don't think the world has today an alternative to US dollar. And so I don't see any dramatic changes in that. And I think that might be a key thing that helps US dollar. retain its status. And as far as the currency moves, as I said, ultimately it boils down to the differences in inflation. If you notice, Indian currency has not as depreciated at a lower pace in last 2-3 years versus US dollar, and that's perhaps because of the inflation differential coming down, because the US also had some inflation.
Absolutely. So coming back to the India focused, I would say investing style, which is, your forte. What are the sectors apart from IT and financial services where you want to kind of give a positive view and where you see that, yes, financially 26, these are the sectors which are going to contribute to India's growth, as well as we will see these contributing to the stock market's growth?
So I think a lot of our investing is focused on not so much 1 year opportunities, but where we see growth on a longer period basis, because that's how we value companies, for what their potential is for longer period. And I think we continue to see opportunities in healthcare, whether it's domestic pharma or hospital space. We continue to see opportunity in the digital music space. The platform players who provide, basically act as an interface between customers of service and providers of service, or customers of goods and providers of goods. Within financial space also, we are particularly interested in the whole wealth management side of the equation. We continue to see strong long-term growth for life insurance. And I think after that, it boils down to individual opportunities, across the whole range of sectors, rather than having any big sector bets. Because I think what happens is that when particular sector looks promising, the trades get very crowded and valuations get bid up unless we are very early. And with that kind of situation, we get priced out because of our framework.
Sure, Bhavin. We have seen in last 4 years was a kind of a washout kind of a period for some of the older leaders, which we then used to call as consistent compounders or quality businesses. To name a few like Asian Paints, HDFC Bank, and likewise. Some of those stocks have badly underperformed, and now their valuations have, I think, become half or even less than half. In your rules-based investing, where valuations play a very important role, in the current scheme of things, do you see such stocks leading this bull run? And hence, are you also adding them with a 2 to 3 to 4 year view, as you mentioned that, you kind of add businesses with that view?
Well, we are looking at some of the spaces, and if we see something meet our criteria, we would. But our criteria tends to be fairly stringent, and I think it is. I don't see a whole lot of such companies yet meeting our criteria, either because valuation is still not low enough, or the growth itself is not very exciting enough. So yeah, that's where we are.
At one point of time, you took a very brilliant cash call. Investors were criticizing then, because it was a period where markets were rallying. But at that point of time, you were confident that markets will come off. And when market actually fell down in January and February, you were the fund which actually did not fall much. And that is where I think, you're back on alpha. So markets fell more, you fell less. Now at this juncture, what are the cash levels and how are you positioning your overall, I would say, equity allocations?
We are actually, we have deployed, more money recently, and as a result, in mature accounts, we have very low cash levels. Obviously, in the newer accounts, accounts less than 1 year, we still would be having cash, because our investment process is still ongoing. But yeah, I think, for any account older than say, 18 months, will probably be fully deployed, close to being fully deployed, maybe like sub 4% kind of cash levels.
Sure, we broadly understand, your investing style as a rules-based investing, and you follow your own checklist. But if you could take example, of a stock like Indigo, which you added and increased weights, and that turned out to be, I think, one of the best performing, bets that you took in last 6 8 months. Taking the example, how did you identify and how and why you increased weights, and what are your, I would say, expectations? And if you want to cover any other stock, if not this, you're happy to do that, because I want you to take an example of a stock and explain your ideology and your philosophy, because it's a very, I would say, theoretical style. You churn less, which is good, which ultimately in longer term delivers very good returns in the hands of investors net of taxes. But obviously, the journey keeps investing very boring. Investor feels that I'm not making money when markets are rising, but to get the fruit of that, ultimately one has to wait patiently. So over recent past, we have seen a lot of events unfolding. Taking the example of recent past, you took cash call, you took uh, addition of like stuff like Indigo. How did it go? If you take few examples and explain that.
Yeah, so I think Indigo is something we have invested in 2017, and I think it's a good example because it also reflects our investment style. Because at one point, so we invested early when nobody was interested in Indigo. There was a lot of negative thought process around the industry, and we actually stayed with our investment, even though Indigo itself also went through some turbulence, along with the industry and some of its own with respect to split in the the two promoters of the company. And then I think we also took a complete exit at the early stage of COVID, and re-entered later when the stock corrected. So what I think, and then since then we have actually just been owning the stock, maybe adding at times, hardly really reducing the position. I think what has played for us with Indigo is one, the large opportunity in the Indian aviation. I told you that we don't look at 1 or 2 year opportunity, growth opportunity, but we think about what is the growth potential for much longer periods. And in case of Indigo, by looking at how aviation market has evolved in other countries, including China, we saw there was a huge opportunity. Second, the government post 2014 was very focused on developing the airport infrastructure, which was very important for the airline to grow. Third, Indigo's business model. Very few airlines have succeeded in terms of delivering shareholder returns, and those who have succeeded primarily come from the sort of the thought process of focusing on cost and efficiencies and safety versus any kind of frills. And Indigo, I think the companies like Southwest Airlines had delivered phenomenal returns for a very long period of time. If you take the same starting point out for them as Indigo and sort of plot that over time, and same thing for Ryanair also. So I think Indigo is sort of similar business model, but they have even innovated even beyond that. And I think we saw the other airlines had one or the other issues, and the expectation was that when going gets tough, the guy with the lowest cost tends to win in a competitive industry. And that's what happened. Every downturn, Indigo gained market share, and we saw that in the numbers also coming through. And I think part of the reason, one very important aspect of their success was also how smartly they've ordered aircraft, both in terms of choice of the aircraft maker as well as in terms of the procurement strategy, in terms of the pricing. So I think when you're in a competitive industry, cost matters. The biggest cost in the airline is obviously the cost of the plane, and they won there. And I think there are a number of other operational efficiency factors that you can observe from seeing how Indigo operates. So I think it played out, and I think as the industry consolidated, our thesis became only stronger, and still the market was not rewarding the airline for the valuation that it deserved. So we kept owning or adding to our positions, and then I think we are now seeing that Indigo's market opportunity has increased significantly, both in terms of the domestic, near sort of short distance, short haul outside India, and also long haul. And I think the industry has kind of shrunk to really very few players and with the main competitor still in a multi-year sort of reconstruction of their business, during which period they are unlikely to cause any unhealthy price competition. So I think Indigo has really got a kind of a open space to play, and I think that's why they are able to grab any opportunity that industry gets. And I think and as we have seen in the recent past, where there were a number of reasons why travel increased significantly, and Indigo has been able to take lion's share of it. So I think and I think that it is a great story from the point of view of staying invested, because at any point in time we looked at incremental returns have still looked interesting. Albeit I will say that from here on, there might be some pause, but still I think there is a scope for further appreciation, and that's why we stay invested in names like that.
Sure. Thanks, Bhavin. For our viewers, I'll just give a disclaimer that we may have discussed the stock. This is not to be construed as any advice. It is just for learning purpose, because Indigo is one of the top stocks in Sameeksha's portfolio. So, Bhavin, moving on to the subsequent, I would say, aspect. For your clients, assume that you are wanting to give a commentary on your guidance on the fund, on the guidance of the PMS in terms of what to expect from the portfolio in the new financial year. This financial year has opened up with a lot of, I would say, creative destruction-oriented challenges as well as opportunities. And your portfolio, as of now, based on your rules-based investing, was geared to participate. And as market became more tough, market became higher on valuations, it kind of showed its strength. And that is where, even despite market falling broadly, in last 1 year you have delivered alpha. Like markets would have given around, I would say, 5-6% in last 1 year, and you still would have given around 12-13%. So you are out of the market by 2 times. And in last 6 months, if markets fell 12-13%, you would have fallen by, I think, 5-6%. So that's the equation. Like in 6 months, when markets were tough, you fell half of the market. In last 1 year, when markets were good, despite the fall at this present point, you have delivered twice of the market. So obviously, this raises the expectations. And we are not saying that you will do magically the same thing in short term. But if you have to give guidance to your clients based on the portfolio's earnings growth, based on the current valuations, based on your expectations, because you are equally invested in your portfolio, your skin in the game is substantially high. We understand that.
So I think what I would say is a few things, right? And there's something that I say every investor that we speak to, that whenever we invest in a company, we invest with certain absolute compounded return expectation over a horizon of 2 to 3 years, and that expectation can be as low as say around 11-12% if it's a large cap liquid name with a very stable business cash flows, to as high as 24% if it's a small cap illiquid name. So, and this, the expected return is something we derive using sound valuation methods and derive using intrinsic value for estimation. Something that Warren Buffett talks about as the intrinsic value based on discounted cash flow. So, if an expected return from a business is less than required rate of return of anywhere from 12 to 24%, we do not invest in such company. Even if let's say we have cash and we don't, if we don't find any investment idea, we sit on cash. Now this approach, I think, ultimately has worked out because we are under pressure when we have cash in the portfolio to look for ideas, and so we, obviously means that we are, doing our work, and Indian market, fortunately, is a fertile ground for stock picking, and so opportunities are there to find for those who are looking for them. And I think that is why we have been able to deliver what we have been in terms of a median alpha of 9% over 49 rolling 5-year periods that we have completed. Now coming to the Indian market outlook and what sort of long-term return one can think about. I mean, there's no, I don't have a very, very complicated framework for that. All I can say is, our economy is likely to do 6 to 7% real GDP growth, let's say, and you add 3-4% inflation on average. in a reasonable government environment, then we end up with 10 to 11% nominal GDP growth. The listed corporates have, I think, have the potential and have historically grown at a faster rate than that in terms of earnings growth. So I think low teens to maybe a little bit higher kind of market returns can be expected, and hopefully we strive to do better than that. And our investing approach has yielded results which are better than that, much better than that. So that's what we strive for. Don't want to make any kind of promises around that.
Sure, Bhavin, we get that. And one last question, I'm picking from one of our clients who has asked on chat box, why do you have 40 plus shares in your PMS currently? As an investor, we choose to select selection of a few stocks in PMS. It looks like mutual fund, kind of a portfolio. So I know, the answer is, but obviously, the investor has asked this question to you, and investor has all the right to ask every question. She's one of our clients, and please go ahead with your answer.
So, we follow certain rules around portfolio construction. These rules are about individual position size, and less liquid the name, the smaller the position size we would take. That's one rule. The second rule is around liquidity we want to have in the portfolio. So at any given point in time, we want to be able to generate liquidity, exit equity exposure and create cash in the portfolio should the situation demand that. So, that is another important rule we follow. And these rules, by the way, are hard-coded in our in-house software which we use to run our portfolio strategy. So when we look at these two factors, and considering the kind of amount of money we want to invest, and the minimum position sizes we want to build, we have allowed ourselves flexibility to own around 40 stocks, which means, a fair number of small positions in small cap illiquid names. I think from an investor standpoint, owning, say, two companies which are looking promising, having, say 3% position in both, having 6% position versus owning three companies with 2% each in position size, the end result may be similar, but the risk of the one with three stocks is going to be lower. And we are of the view that Indian equity space offers many opportunities. So instead of having high exposure to individual positions, which increases the risk in the portfolio, we rather limit our risk. Because see, what happens is if you buy a small cap, it's easy to buy. We might jack up the price also while buying, and your monthly portfolio statement might look good that, we bought this stock is already up. But the reality is that if our call is wrong and we are stuck, a large position becomes very, very difficult to exit. And that's why, it is rather better to have more stocks up to a point than to have fewer stocks. And I think, by the way, I know of my peers, some of them who have even more number of stocks in their portfolio and delivered very good performance as well. So I think the point is that, and what we do to actually have a larger portfolio is also have a larger team. We have, almost, close to 15 people working in equity research, including people doing some macro work as well, and backed by additional software development team. So there is a large deployment of resources, so that no one person is required to produce so a large number of ideas in this number 40 that you mentioned, and so there is a conscious execution plan to make sure that we are able to have a portfolio of 40 stocks that deliver performance.
Sure. To answer, Mr. Sriram's question on percentage of mid and small cap, I would say it is broadly 60% in mid and small caps, 10% in cash, and 30% in large caps.
I think as of now, 30% in large cap, 32%. That's right.
Perfect. Would you also like to answer the second question that he has asked? Where are you investing in global portfolio?
We are investing in. I think there is still a fair bit of exposure to tech. There is not just US but non outside US tech. Especially the semiconductor side of the equation. We are, I come from semiconductor background. We also invested in healthcare related names, some industrial names, automobile. So yeah.
Perfect. So this is one last question, which is a common question which investors ask, because investors mostly have started their journey from mutual funds, and mutual funds industry operates on the narratives of large caps, mid caps, and small caps, and that is why investors tend to ask these questions. But obviously, you as a fund manager try to identify growth in earnings over say next 3 to 4 years, and then obviously weigh that with present valuations, be it large, mid, small. You are not biased towards any of these categories. However, putting yourself in such investors' shoes who are evolving from mutual fund investors to becoming PMS and AIF investors, and as you rightly mentioned at the beginning of this conversation, that the large caps were looking very attractive and they were to kind of go up. And a lot of investors today are keen to put money in index funds because many mutual funds have not outperformed the benchmark. And if large caps are seriously very attractive, investing in Nifty 50 makes the best sense. Obviously your fund has delivered alpha and your portfolio is not having any bias. It is index agnostic portfolio. But what is the answer that you want to give to such investors, such clients, who are learning and evolving from the mindset of seeing the market, from the lens of large cap, mid cap, small cap, because they try to structure their portfolio that this percentage I am holding in large cap, this much in small cap, this much in mid cap. You yourself are investor and you must be having your own method also of managing your own portfolio. If you have to advise to such clients, and if we have to borrow your way of viewing market while allocating equity, from after doing the asset allocation, I'm talking about equity allocation.
So I think it is, not just India, but generally speaking around the world, the opportunities tend to be the most lucrative in the small cap space. Investing in small cap is obviously tricky. One has to do a lot more close scrutiny before dipping into it. Obviously, there is this whole Mag 7 concept, that those have delivered very strong results for the US market, and they have outperformed small cap indices as well. But I'm pretty sure that there will be small cap fund managers who would have also done quite well, by doing very good stock picking. So the role of an active fund manager is very, very valuable in a small cap. But I actually tend to think that one can also generate alpha from large cap if one doesn't have to always just be in large cap. Number one. Number two, one is flexible enough to keep money in cash as well, when the opportunities are not there. And three, one is careful with in terms of what they pay, as well as how they choose the names. Because large cap stocks also, from time to time, there are companies which are mispriced by the market, which are going through a major transition, and market is not yet ready to reward them. I think ICICI Bank, which is something we owned for a number of years, was in that situation when there was a change in the management, and the new management was trying to do a lot of right things, but market was not ready to reward it for that. So I think opportunities can also be found in large cap. But yes, the reason why investors get disillusioned is that a lot of large cap fund managers tend to run very large portfolios, and so the pressure of AUM, I think, affects the performance. I think if the fund manager doesn't have a lot of pressure of AUM, they're trying to work within their constraints, they can deliver. A good fund manager can deliver outperformance in large caps too.
Sure, Bhavin, we have 10 minutes to go, and I see more questions coming. So if we can maybe take 10 minutes more, I'll take these questions. May I?
So,
Bhavin?
yeah.
Please, yeah.
So I think I can see the question. I mean, I think there's a question on gold in the portfolios. I think we tend to have, maybe 4 to 5%. Although we have, with a recent rally, we have not really bought. We have not chased the rally, but yes, in the past we have tried to keep the gold around that level. Are you currently invested in your own portfolio? Well, I started Sameeksha to manage my own money in a professional setup. So everything I had in Indian equities or even other cash, I put it into Sameeksha's funds. And every strategy that we have, I have my own commitment as well. I don't have any separate side portfolio outside of that I manage. So there's a full total alignment with clients. Is global portfolio more US centric? Yes, it is. US is the largest equity market. But as I explained earlier, by investing in US companies, you in many cases get global exposure, even from a US based companies listed in US, as well as companies based outside US but listed in US through ADR or direct listing. Any strategic shifts towards large cap allocations? I mean, I think there is no strategic shift towards large cap. Currently the risk management rules that we have, we are satisfying those rules. So we don't need to kind of force a change in the allocation. But yeah, if you find some good large cap opportunity, we would invest. We have invested some money in large cap even recently. I think country-wise allocation, I'm not sure if I have it ready here, but I think I think large percentage, maybe 50 to 60% is US. But within that, some of those companies are global in nature and they have exposure to markets outside of US. Gift City different than normal AIF. Gift City AIF is for investors from outside India who want to invest in India. We are giving them that route. And Gift City AIF has certain advantages that we can discuss separately. Any overlap between AIF and PMS, it's whether it's AIF, domestic, Gift City, or PMS. Our investment strategy is same. We only have one investment strategy. We buy, on a proportionate basis in all three, and we sell on a proportionate basis in all three. So that there is no portfolio that is advantaged or disadvantaged over the others. So in unlisted space in AIF, well, yeah, I think we do have the flexibility, but have you invested? No, we have not invested so far. We would invest only if it's a company that is closer to the IPO and we meets all our criteria. Then we might have a small part of our AIF also in unlisted, but historically we haven't. Max 7, I think some of those companies, obviously one has to look at how this whole Chinese tariff situation evolves. But assuming that final picture may not be too bad, I think those companies are generally looking they have strength. Each of them have certain strengths, and certain allocation across the board makes sense. Although we own many other companies outside of Manocha. Model portfolio. Well, yeah, I mean, we have a list of stocks which are currently available at the right price. They have buy levels for every stock, and whichever stocks meet our criteria, that we would buy it in any new money that we have, and then to a position size that we have set the rule. Performance of our global portfolio. So if I can just shed some light on that, just 1 second. So I think obviously it is a PMS. The global portfolio is also a PMS strategy, and so it is important to differentiate between the investment period of different investors. If I look at our oldest investors, which are more than 5 years, they have seen dollar returns of 17% versus the S&P 500 at 12%. So there's about 5% alpha. The investors who are about 2 years old, they've seen 23% return versus 16% for S&P 500, so 6.5% alpha. And 1 year old investors seen about 18%, so about 1% alpha. And I think investors who are relatively new, less than 1 year, they have seen about 5% return, so roughly similar to the index. But I think we can separately, if anybody is interested, share the data on that. So yeah, I think Kamal, I've covered most of the questions I can see.
But one question, Bhavin, which someone has asked me privately is on Indigo, that you mentioned that there are certain weights criteria, but Indigo's weights are like closer to or above 10% in certain portfolios. What are the reasons for that, and what is the guidance that you want to give to investors on that?
So we allow ourselves up to 15% weight at cost and up to 25% at market value in PMS. So we are far below that limit, and we also know that it's a liquid name. If we ever needed to exit, we could exit very easily. We are a small fund, and that's the beauty of being small. And we will, I'm sure, will always be small. Indian market is too big, and I think as long as we maintain that liquidity rules, we are not concerned about having a strong high share in any one name. IFSC. There's one more question. IFSC domicile global equities fund. Well, we already offer global equity strategy through, depending on the investor, whether it's from India or abroad, they can, it's in a PMS structure. In a fund structure, we plan to launch, in near future. So for some investor, the fund structure may be preferred, but, we already have a PMS structure in which we accept, both Indian residents as well as non-Indian investors.
Perfect, Bhavin. Thank you for your time. I have given the link in the chat box for anyone and everyone who may want to do conversations about their portfolios, their existing investments and new investments with us. We are quite thorough and quite sincere in our approach. We at PMSA World will welcome if you're a right profile investor to become our clients, and we service really well. I see most of our clients, are already logged into this webinar, and I'm sure, these clients' testimonies, which are also given on the platform, is a good starting point for any one of you who is interested to get answers to some of the more questions that have not been answered yet. So you're most welcome to book appointments with us. Thank you everyone for joining today. Thank you, Bhavin, for your time.
Thanks, Kamal.